Hey everybody! How's everybody doing? Big Memorial Day weekend coming up here in the States. Traffic is already getting a little crazy here in New York City. Um, anyway, I hope everybody's doing well. I have a little story I want to tell you today. I believe it was back in 2012, I was invited to speak at a conference um, and it was a commodity conference held here in Manhattan, and I was on a panel. It was kind of like a debate thing, me against some other guy. I had I guess, a bearish view of commodities and gold, and the other guy, he had a bullish view of commodities and gold at the time. So this was maybe, I don't know, mid to maybe the fall of 2012 or something like that. We were already into, I don't know, it must have been maybe the second iteration or the second program of quantitative easing or whatever. Fed had taken rates down to zero. Now, of course, this guy, he argued, he said, well, the Fed's printing money and the rates are zero and it's inflationary and hyperinflationary and QE and they're printing money and, all this whole story. And I just calmly said, actually, that's wrong. It's the reverse. What QE does, what this asset purchase program does, is it removes income from the economy. It takes out, when you take rates down to zero, when you buy interest bearing assets, when you remove them from the economy, you literally strip the economy of income. So it's deflationary. And my stance was that you got to sell gold and you have to sell commodities because all of that inflation argument stuff that you were hearing at the time, that people were saying, just like this guy said, that's wrong. Now at the time, I think 2012 might have been the time when gold got up to, I don't know if it was 2011 or 2012 when it hit 1900, but anyway, when I gave that talk, it was already backing down, but it was still pretty high. It must have been in the 1800s. So that was kind of a scary call, not for me because I was very confident about it, but it was scary in the context of, what was going on at the time. At the time, you thought like, wow, this is out of control money printing, at least if you listen to all the know nothings out there. And so, but I was very confident. Now, did gold crash the next day? No, you had to be patient. But what I'm trying to say is here's the point I'm trying to make. We're in the exact same situation now, only in reverse. Okay? The Fed is raising rates. That's going to set in motion an inflation cycle through, I've explained this in the past. Rate hikes are price increases that get passed along to every other thing in the economy. Producers pass the cost of production along. In addition, labor market is tight, and the federal government now with higher rates will be spending more money in interest, and that will flow into incomes that will increase demand, that will increase wage pressures, right? So, and I know some of you are long gold. You're maybe long gold on my recommendation recently. And let me just, full disclosure, I hate gold. I can't stand gold. And there's a guy here who posts up comments how he loves it when gold crashes because he wants to see the gold bugs wiped out. And I totally understand your sentiments, dude. I hate those gold bugs myself. But, as a trader, there's times you just got to set aside your emotional, right? That's detachment. I got to detach myself from my hatred for gold and the people who constantly talk about it. This is a trading opportunity. So we're in a rate hike cycle that's inflationary. This is the same thing I said in 2012 at that conference, only in reverse. You don't have to listen to me. That's fine. But 6 months from now, 8 months from now, a year, 2 years from now, if we're still in this cycle, believe me, gold's going to be a lot higher. Commodities are going to be a lot higher. And by the way, you know what the best inflation hedge is of all? It's common stocks. Stocks. Companies raise their prices. It gets passed along. I like stocks. All right, that's it for this video. Maybe see you later. Bye-bye.